Hello, everybody. Kind of continuing down what we've been looking at in this new video series is we're now going to be kind of heading over and looking at the sale of equipment. My name is Bennett Tchaikovsky, accounting professor. This presentation is copyright 2008 to 2024 by myself. Any redistribution is expressly prohibited without my prior written consent. Opinions expressed herein are those of myself and not my employers or any other organizations, including but not limited to Irvine Valley College in the South Orange County Community College District. Let's go into it, right? So on May 1st, 2026, PI purchased equipment for 500 grand. The equipment had a salvage value of 20 and had a useful life of 5 years. PI uses straight line to determine depreciation expense. Assume that PAE sold the equipment on July 31st, 2030 for 18,000. What was the amount of accumulated depreciation as of 7/31/30? Prepare the journal entry to form the sale of equipment. Okay. So let's go through and talk about this. So when the asset was originally acquired, and uh, when the asset was originally acquired, so we have equipment. So when this asset was bought, this was bought for 500,000. Okay. So the asset was basically purchased for 500,000. We would basically say here 5/1/26. We basically would debit equipment and credit cash, maybe credit notes payable, whatever it might be. But that's what we did to go through and to purchase the equipment. Now, in terms of what happens with this equipment every year, is we have to basically record depreciation expense. And when we record depreciation expense, we are debiting depreciation expense and we are crediting accumulated depreciation. Depreciation expense is a temporary account. It gets closed out to retain earnings. Accumulated depreciation is a contra asset account. It's going to reduce the carrying value of the equipment. When I sell an asset, I have to take the asset completely off of the books. So therefore, what I need to do when I sell an asset is I know that I'm going to have to credit equipment over here on 7/31/30. I'm going to have to basically credit equipment for 500 grand. I know I have to do that. I have to get, when I sell something, I have to get rid of it. But at the same time, from 5/1/26 to 12/31/26, then all of 2027, all of 2028, and then up and even in 2029, and then up until 1/1 through 7/31/30, I've been using this asset. So what I need to do is that I have to take off everything that it relates to this asset. So it's going to be the equipment. And I'm also going to have to be debiting accumulated depreciation. So be debiting accumulated depreciation because this will have a credit balance, right? Because when I record depreciation expense, I'm debiting depreciation, gets closed over to retain earnings, but I'm crediting accumulated depreciation, which is a contra asset account. So when I get rid of this thing, I'm going to have to basically come over here and basically debit accumulated depreciation for that amount. Now, the other thing we also have over here is we know that we're getting cash. We're receiving cash of 18,000. Okay, so let's now go through and figure out how much depreciation expense we need to record. So the way I'm going to do it is it says it uses straight line. My formula for a straight line is my acquisition cost minus my salvage value divided by the estimated useful life. So the acquisition cost is 500,000 minus the salvage value of 20,000. My estimated useful life is 5 years. So this is going to be 480,000 divided by 5. So the amount I would go through and take in terms of depreciation expense each year would be $96,000. Now, for this first year, did I use the asset for the full period? And the answer is no. I used the asset for how long? May, June, July, August, September, October, November, December. I used it for 8 months. So I'm going to take 96,000 times 8/12. So this will be 96,000 times 8 divided by 12, or 64,000. In 2027, I use the asset for the full year, or basically for $96,000 worth. And also for 2028, used it for the same amount. 2029, used it for the same amount. Coming over here, though, in 2030, when I sold the asset, I used the asset from January 1st through July 31st. This is really important and what oftentimes screws students up when you're going through and it confuses them. It's like, wait a second, how do I figure out up until the date of sale? So this is going to be January, February, March, April, May, June, July. So a total of 7 months. So this is going to be 96 times 7 divided by 12, or 56,000. So this is going to be 64 plus 96 plus 96 plus 56, or 408,000. That's the total amount of depreciation that I have taken to date. So we come over here and we say, okay, we have 408. Now, if I look at this logically, the net book value of the asset over here is going to be equipment less the accumulated depreciation on the equipment, or 408. And this is going to give me equipment net of the accumulated depreciation. So my net book value is 92,000. Now, when I look at this entry, right, I have 500,000 of credits. I have 426 of debits. What do I need to do to balance? Well, I need over here a $74,000 debit. Now, what exactly is this? This kind of look at it like an expense, but in our case over here, this is really a loss on the sale of equipment. What's very important in terms of understanding this of equipment. So why did I lose money? Well, it was on my books for 92. This is how much it was worth to me. I sold it for 18, which is less than the net book value. So therefore I lost money. So we have this as a loss. Now, when you're doing these problems, right, to make this easier on you, here's what I would go through and suggest doing. You're going to have, we always know we have to get credit equipment to take it off of our books. We have to debit accumulated depreciation to take that off of our books. We're debiting cash because we're receiving cash as a result. If I have over here, basically, if I need a debit, this is going to be a loss on sale of equipment. And I call this a balancing entry. If I needed a gain, if I needed a credit to balance, this would be a gain on sale of equipment balancing. So instead of doing this whole net book value computation that I just went through over here and completed, you're going to be better off memorizing this journal entry. And if you kind of think about it intuitively, it kind of makes sense. But it's like, okay, I have to take the equipment off my books. I have to get rid of that accumulated depreciation off my books. I'm getting cash, but here I need basically a balancing of 74,000. When I go and basically add this up over here, 74 plus 18 plus 408, my total debits equal my total credits. But if you think about it, well, it was worth to me 92. I'm selling it for 18, so I lost money. I bought something for 100, I sold it for 20, I've lost money. And this over here is going to be to record sale of equipment. Okay, now here's another one over here, which is basically going to basically saying using the same facts above, except that on April 30th, we sold the equipment for 211,000. So, but let's go ahead and answer this. So assume that PE sold the equipment. What was the amount of the accumulated depreciation as of 7/31/30? It was 408. Prepare the journal entry in proper form. That is what this entry is right over here. So now let's go through and take a look at this. This question is slightly different, but let's go ahead and take a look. So over here, it's the same scenario, except that we're just selling this on a different date. So it says that assume the same facts above, except we sold on April 30th. So now, if I'm selling on April 30th, 2030, what I'm going to be doing here is 1/1 to 4/30/30. And now I have to say, okay, the annual amount of depreciation expense was 96,000. How many months did I use it for? January, February, March, April. I'm going to multiply this by 4/12 and I'll get 32,000. So my accumulated depreciation as of April 30th, 2030 is going to be 384. So coming over here on 4/30/30, what I want to do is I want to write in all the information. So I'm going to say loss on sale, balancing. This is the journal entry we want to have kind of memorized. Accumulated depreciation, equipment, cash, forgot cash, hold on. Equipment, gain on sale of equipment. Now, with this accumulated depreciation that we just went through and computed, we know that basically that balance right over here is going to be a total of 384,000. This problem also tells me that I'm selling it for 211,000. Assuming my cash, yeah, I'm getting 211,000 cash, and that the equipment value has not changed. It's still going to be at 500,000. Now, if I use the kind of same thought process in terms of going through here and saying, okay, what do I need to do to balance? Well, over here I have 595 and I have 500. In this case, I need a credit of 95,000 to balance this equation. And this is going to be a gain on sale of equipment. I don't have a loss, we have a gain. But why do we have a gain? Well, think about this. The equipment on my books had a net book value over here of 116,000 for this particular question. So my equipment net on my balance sheet was 116,000. What I'm going through and doing is I'm selling it for 211. I'm making money. So I therefore have a gain. However, if you follow this methodology, like we credit gains, debit losses, if I go through and follow this methodology, you'll be able to answer all of these questions, hopefully correctly. This is one of the journal entries in accounting I generally tell students to memorize because you'll see this come up pretty frequently. So in any event, thank you for joining me here today on the sale of equipment, and I look forward to seeing you on the next video. Have a great day.